Well, you know things are interesting when they start disagreeing not only about the legislation, but why legislation is named the way it is. In that case, Dodd-Frank and Sarbanes-Oxley and so forth. About 30 seconds till Europe closes across the continent, across the pond. Simon Hobbs here to talk about what happened today and to explain why we're so obsessed with the letters LTRO.
If we're allowed to even mention them on the network, Carl. What I think is really interesting as we come into the European close is the power of the Fed and the power of Ben Bernanke. You know, the world is watching what you see on Capitol Hill. Let me just show you where we are on the bond market. We have to mention, of course, this huge dump of liquidity that will come through tomorrow. In excess of $710 billion deposited in the bank accounts of 800 banks around Europe, equal to 5–6% of the annual output of the Eurozone economy. That's why you can see that they're making way for that on the bond markets, and you can see the yields are falling today. We'll see what actually happens tomorrow when that cash is increasingly around for them to use. But take a look at where we are on the equity markets coming into the close here. And this is what I mean about the power of Bernanke. This is how we've traded today, as you can see. This is when the announcement came out of what the ECB was doing. This is the effect, though, on European equity markets of Ben Bernanke not really mentioning further easing, QE3, an extension to the twist going out. And that's taking us into negative territory on those markets, as you can see. Have a look at, say, the French banks. You would think that they would be propelled higher by what is coming out of the ECB. This is the announcement from the ECB. This is Bernanke not mentioning that there will be further QE. So Societe Generale, BNP Paribas, in negative territory, not mentioning that there will be further QE. Obviously, there might be further down the line. Diane Swank, obviously, characterizing the ECB as fighting there for its independence. I just want to show you what's happening to the euro. Finally, no real boost to risk appetite, arguably, within the Eurozone overall on the assets because of what the ECB announced today. But the euro is in negative territory. Again, you can see the way in which, actually, as we got that announcement from the ECB, arguably, the euro was much more influenced by there being no mention from Ben Bernanke of that QE, and now there's a lot of chatter about a double expiration in the Eurozone tomorrow in an environment, sorry, let me rephrase that, a double expiration within the foreign exchange markets in an environment where the dollar is mostly positive because of what we didn't get from Bernanke. Give me a break here. That didn't really make sense. I got all tied up.
One thing we know for sure, 523 banks took advantage of this cheap money in December, 800 banks this time. So the stigma of coming and getting these 1%, this 1% money is lessening a bit, right?
Yeah, and it was very interesting looking at the comments from the major banks going in about how they might well tap it. I think the reason you've probably got more banks in this time round is because they've reduced the bar on collateral. So a lot of those smaller regional banks who probably arguably are in more difficulty longer term have been able to get their noses into the trough, as it were, of this
My favorite tweet of the day was someone who wrote, biggest surprise of the day, Europe has 800 banks, which you know better than most.
Well, you know, it is actually the most powerful economic grouping in the world, though let's not dwell on that.
Yeah. Thank you very much, Simon.
Okay.
Let's head over to Rick Santelli, who I'm sure has thoughts on this and a lot more. Good morning to you, Rick.
Good morning, and before I bring in Ira Harris, listen, there's a lot of rumors around the floor from actually major news agencies talking about fat finger errors because we had a sell-off in treasuries. And as I'm speaking, look at these charts in various markets, whether it's equities, gold, 5s, 10s, 30s, boons, gilts, they all moved in a way for a reason, okay? Wasn't a fat finger error. Ira Harris, is there any more LTROs scheduled?
No, actually Simon's comments was exactly right. The Bank of England is kind of backing off.
Right.
The ECB, we know what they did.
And did you hear any more twist and shout from the Fed chairman?
No, the Fed was kind of quiet, and that wasn't the line of questioning, really. So yeah, the market was a little bit disappointed. It's hard to believe when you look at the gold market that it was really built.
See, don't use the word disappointment, all right?
Okay.
This is me you're talking to. So basically what I'm getting to is, if it's seen at least for the here and now, that maybe QE isn't front and center, wouldn't that totally explain and maybe even augur for bigger moves in those markets?
Yeah, but certainly. Listen, a one-handle move, as we would say in the 30-year, off of this is nothing. Fat finger, it's nothing. It's been still caught in this range. The 10 years, moved a half a point down. Yeah, they were up a little bit. Insignificant moves. That was just a reaction to, hey, maybe there's not as much coming as I thought, which, if we're right, we can look at the long end to actually hold in here because we know what the Fed's going to do. There should be more pressure actually on the short end, I believe.
I agree with you. So maybe some curve implications. Curveball back to you there, Carl.
Rick and Ira, let's hit Bob Pisani here, who I know is going to talk about gold. Is this true? Worst day in almost 3 months?
Yeah, it is. We had some very strange thing happen, events in the markets at 10 a.m., just as Mr. Bernanke's testimony came out. And boy, a lot of traders are scratching their heads trying to figure out and sort of reconstruct things. I want to put up the 10-year Treasury because this is where the initial reaction happened, and it was a strange one. Take a look here and see if you can take a tight shot at this. Look at this. You do not see this very often. All of a sudden, at 10 a.m. Eastern time, we spiked on an intraday basis at about 2%. We went from 6 basis points up, about 1.94%, all the way to the upside. And that kind of got people wondering, what the heck was Mr. Bernanke saying? And this is just as his testimony came out. We were still reading it, trying to figure out, why did everybody react so negatively to it? There have been some vague rumors of a fat finger trade in 10-year Treasury trading. That may or may not have been a factor. But clearly, that got a lot of people talking within a minute or two after his testimony was released. Most people feel right now that the fact that he was commenting on an improving labor market, he did say, for example, we have seen positive developments in the labor market. That and the fact that he did not at all mention in his testimony QE3 or Operation Twist ending on June 30th. That's a clear indication, and Simon referenced this, that withdrawal of liquidity for the markets is generally not good for stocks. And that's probably the most important thing here. I want you to put up, so if you take that assumption, guys, you have to work under the idea that you sell treasuries and boom, look at that on the dollar here. You buy a dollar, you get a rally in the dollar, and then all the commodities follow from there. Put up gold. There's a logical development, of course, is sell gold. There you go. Look at that, straight down. All this happened within minutes. And so my IM lights up, my machine lights up, what the heck? We're all reading microscopically the testimony to try to figure out, parse what he's saying, but he didn't say that much different.
But what is interesting I mean, you talk about the fat finger theory. When you have a move that is confirmed on both sides of the Atlantic, from the French banks to the euro to gold, that's not fat finger. That is a market that is increasingly discounting the prospect of further quantitative easing, not a withdrawal of liquidity, but less further liquidity down the line.
I agree with you. And of course, the ECB has given body language that they too do not want to have another 3-year facility. We're not calling it an LTRO. It's a 3-year facility that's going to be coming down the road.
Central banks like to copy each other.
Yeah.
They have a received wisdom as where they are in the world, and they kind of like to all be on the same page, which of course the ECB was not for a long time. It wasn't easing when the Fed was.
Before we go, just put up the stock market here, and you can see the risks part of the sectors. Put up the sectors here. You see materials, industrials, energies, and financials. There's your heavier risk side. They're the ones that dropped the most today. So all this is consistent with the idea of QE3 off the table for now, labor market improving.
That's right. And as you pointed out, gold, silver, 7% decline today.
Huge.
All these commodities, there's a look at 34.63. What talking about some dramatic moves, all stemming from the chairman. Thank you very much, Bob. Be right back with more of Bernanke's testimony on Capitol Hill. Plus, the CEO of Ryder Systems with us live. Before the break, though, a look at some of the winners and losers from Europe's trading day just now ending.